Fed, 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 Fed. Hey, hey, hey.
See decision in just a few seconds.
Let me remind you that trading is risky, not appropriate for everyone. The past performance, good or bad, is not necessarily indicative of future results. Stay small, stay humble, focus on long-term, never risk money, cannot afford to lose.
Hold as expected, IOER cut by 5 basis points to 2.35%. Unexpected cut in the IOER to 2.35% from 2.40%.
The vote was unanimous. Vote was unanimous, saying Fed overall end core inflation have declined on a 12-month basis, and they're removing the reference to low inflation being due to energy prices. So as expected, taking out the nod to energy prices in regards to weakness in inflation. Reiterates they will stay patient on rates as the economy is solid and inflation is muted. On the IOER cut, saying the move was intended to keep rates in the target range.
Job gains have been solid. Growth, household spending, and business fixed investment have slowed.
They found something to cut.
Acknowledging survey-based inflation expectations have been little changed.
Yes, I can, Richie. Little anti-dollar moving.
Overall, we've seen a slight uptick in bond prices, rates continuing to trend lower. The 10-year down to 246.
246.
Stocks little change. The Dow up 34, the S&P up 3, and the Nasdaq still leading up 35. Gold futures getting a slight bid into positive territory at 1287. Some volatility in FX, but settling in the euro up about 1/3%, a little higher than we were heading into the statement of 112.55. The same goes for cable.
So I love the dollar weakness. Oh, show.
30.94.
So that should prop up gold as well. Everybody likes cheap or free money anyways, right? Good. Cheap money.
And with a cut in the IOER, we are seeing Fed Fund futures contracts the remainder of this year and next year trade into positive territory.
Give me some cheap money.
For the expectation
for a give me some cheap money, honey. I like my money cheap. Give me my money. I want my cheap money. So that's good. It should be good. Prop up the stock market, but you know, bond yields are falling. That's the part that sucks. But anyways. Cool. So I think the Fed's just trying to do something that is just, they want to show that they're not doing nothing. Right? So anyways, they're finding something to cut, like, hey, somebody cut something that doesn't matter. What should we cut? Anyway, so anyways, positive here. Let me make sure, like, what is that? 15, 15, 15. 15. And generally positive, right? So what does this mean? Risk on, baby, risk on. Risk on. It's good. So the next thing is you either counter trend it, which means you sell into it if you believe this is nonsense, or you buy a dip. Let us be picking one. Let us be picking one. All right, let's do it this way. We'll do it on a oneer. But a change in policy, guys, is not something expected. Okay. Change in policy was not expected. All right, there's our line in the sand. I'm going to highlight a role reversal. Hey, Hen. Let's see if there's anything else on that data set. So remember how the main meeting used to be a dead meeting? It's a live meeting now. Vote was unanimous. All right, you son of a... Here's how we're going to vote. Yeah. Just trying to show you. I got to do it over here. Hang on. Thank you, TradeTheNews.com. So what they're showing here is the change last month's statement and this month's statement. The economy rose at a solid rate. Rose versus slowed. Overall inflation and inflation for items other than food and energy have declined and are running below 2%. So we're missing their target. So core is below 2.
No early market on close, and the S&P names on the NYSE are the sell side, about 800 million to sell in the early going.
Okay, buyers are anyone buying dips, dude? Anyone buying dips? Boop, boop, boop. But this is a better price. This is an okay price, but you never know. When you get a change in policy, an unexpected change in policy, the volatility is going to be higher than usual. So I don't know if you're doing a 21.4 is what I'm trying to say in English. By the way, the best way to increase inflation, push up oil prices.
And the NASDAQ now probing fresh session highs here at 78.62 in the futures. The NASDAQ composite up 45. Rates continue to fall here in the U.S. Looking at the U.S. Treasury yield curve, short rates falling even faster now. We're seeing
this moment of truth. Line in the sand coming up.
Widen once again. 10-year spread approaching 25 basis points.
Yeah, I do. AM Media Trailers. You look nice. I like your blouse. Have you lost weight? It's true. Because now we have to say, what was that thing you messed with? Yeah. Do you need some time on your own? Do you need some time all alone? Well, you're sort of reverse engineering it. But let's talk about inflation in general, Guy. It just means prices are high. All right, heads up, shields up, red alert, burp, 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 burp. That's right, life. Burp, burp, freak out, freak out. Burp, burp, burp. Who's going to do it? Anyone going to do it? We see you, AM. That's what I'm saying. AM. What are you doing, AM? Yes, says Glego. Hey, this is the big. We'll see if it meant anything. Huh? We'll see if it meant anything. Did she hold? Where are we going? Okay. We've hardly gone anywhere. Notice that the basic entry, if you happen to be a bull, was, has happened a million years ago. Nice little sort of Monday morning entry, la-di-da-di-da, la-di-da-di-da, right? But if we have a bullish move already in place and this is just follow on, what's the target? Do you know? There it is. Wowzer. $1.27. So it's only 200 pips, but it's a start. Whoa. Okay, you see that, guys? So in that case, if that's what you believe in, let me reset it now. How do you trade? Up, 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 down, down, buy. Up, 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 down, right? Up, 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 roll reversal, somewhere around there, buy. Down, buy. Up, 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 somewhere around here, roll reversal, buy. up, 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 and you go all the way to $1.27. We just passed $1.25, but you should have been on at $1.24. This was a 300 pip move. It's already up 100. There's 200 and crumbs left. Okay, should have had a trade plan on Monday. It would have been finer. Well, it was the cut and the other thingamabobber, the overnight rate, I think it was, right? Well, it's not just the USD interest rate. Okay, many non-OECD countries give up independence for their central bank. So I took a class on central banking. Oh my God, it was such a long time ago. Can't remember, but there was a trifecta of things that you could do. And there were three things, right? There were three things, 1, 2, and 3. Okay? And I can't remember what they are, but let's go with one of them was independence. Okay? You couldn't do all three. You had to pick two and give up one. And many countries will say, how about United Arab Emirates? I'll just pick one. Okay? They give up independence, which means there's a peg to the dollar. Okay? And so when the dollar, or in this case, interest rates in the United States move, many of the world's central banks have to move with it. And it impacts things. Ask Argentina. Ask Turkey. So on and so forth. Okay? There are lots of things. The price of oil is priced in dollars. That could have a positive and a negative effect for like Japan, who imports lots of oil. Even if the oil is not from the United States, it's priced in dollars. So if the dollar weakens, hooray! That's good for Japan. If the dollar goes up in value, boo! It's bad for Japan. Okay? So all these things are very important. Okay? But yeah, I think there's a symbolic sort of thing going on. Okay? So yes, the headline interest rate is the same. Okay? But there was sort of a symbolic cut. Okay? There was a symbolic cut, and that's what's moving this. I'm imagining the stock market's going up and all that kind of stuff, right? Anyways, a symbolic thing to say, hey, stock market, hey, business world, rates are going to be low for longer, and we're doing something to show you, like wink, wink, nudge, nudge. We're not doing much, but we know but you can count on us not raising more, right? I can't remember what they were, Mike, but it was the three things central banks do. And as a country, you have to choose which two out of the three your central bank was going to have as a characteristic. Okay, like a completely independent central bank, for example, like the Fed. You might not be big enough for that. Or it's a tough call. Politically, you might not want that. Also, politically, you want a central bank not to be tied. I mean, so how about this? What if to gain independence from your own government, you gave up independence of your central bank and tied it to the central bank of a different country? You see what I mean? So maybe the royal family of the UAE says, hey, people of UAE, you can trust us. We're not printing money, so we buy ourselves palaces and stuff. Don't worry about that. In fact, we're going to peg to the US dollar, so that whole, manage the countries, the bank for the country, that essentially the policy making is essentially done by the Fed and not by us. And we just want to show to you, the good people of the UAE, that that this is done legitimately and it's a positive thing, and you can trust us, and there's nothing to worry about in that sense, and it's out of our hands. And so like just trust in us. We're looking out for you. That would be a good thing. Other countries print money to pay debt. Right? What if someone came up to you and said, hey, dude, you owe me $100. You open your wallet and you look inside, there's no money. And you're like, oh, man, I'm totally broke again. And you're like, all right, I'll tell you what, buddy. And you take out a piece of paper and you actually make a $100 bill. You're like, who's on the $100 bill? Is that George Washington? No, that's Benjamin Franklin. Okay, Benjamin Franklin. $100. Here you go. Go spend it, right? Well, so it takes that away from countries, and that might be a good thing. Okay, but it's a pretty simple model, Mike. I'm sure if you Google it, you'll find it. It's out of like, I don't know, macroeconomics 101 or something. China deal could be reached. U.S.-China trade deal could be reached by next Friday, says CNBC. That's going to be good for the stock market again. Although announcing it 2 weeks early is bad luck, isn't it? You just know they're going to, if it's worse now, I think. If over the course of the next 2 weeks they don't sign a deal, which I think is more likely than they do sign a deal, then everyone's going to go, oh man, and the stock market's going to crash.
Sees Ken Watanabe on the trade report saying two sources say the deal could be announced next Friday after China Vice Premier visits Washington. Announcement on a summit between the two presidents to follow.
Hey, have you guys subscribed? Please subscribe. That way, I'll invite you to my webinar tomorrow. I keep messing with my watch. I should probably put it down. Thank you, guys. Thank you. Goes on. Okay, this is a 5 minute 382 or 5 minute 50. Okay, you can see the roll reversal there. So nothing's changed yet. Not much follow through though. So let's go through the wording just one more time so everyone has it in the back of their brain, what was actually done. Now think of it, what percentage of the market, what percentage of retail Forex traders like yourself have not actually looked at the Fed statement at all? What percent did not actually see with their own eyes the Fed statement that came out 21 and a half minutes ago? What percentage didn't see it at all with their own eyes? Don't give me like I heard it on TV, and all that kind of stuff. Actually read the statement. What percentage of retail Forex traders have not actually seen the new statement? Okay. So we'll say 2 or 3%, right? Have not, or have. Of the 2 or 3% that have actually seen today's statement with their own eyeballs, how many have not compared it to the last statement, word for word? Thank you, Johanathan. Okay. So of the 2% that did read the report, how many did not compare it? Well, I want to put you in the elite. So this is the statement, okay, from last week, except the bold stuff is the changed words. Okay. Okay. So it used to say, information received since the Federal Open Market Committee met in March indicates that the labor market remains strong and growth of economic activity has slowed from its solid rate. That's what it used to say. Now it says, the Federal Open Market Committee met in March indicates that the labor market remains strong and that economic activity rose at a solid rate. So we're back to solid rate. Yes!
Comments from the Oman oil minister saying the oil market is currently balanced and likely to remain balanced even after sanction waivers for Iran oil are removed, saying the oil price of about $70 is appropriate. Also commenting his opinion the goal of the June OPEC meeting will be to extend output cuts.
It's tradethenews.com. I've had a site license with them for about 12 years. I know, right? On a 12-month basis, overall inflation, and inflation for items other than food and energy, which is another way of saying core, have declined. Overall inflation has declined. Okay? It used to say overall inflation has declined largely as a result of lower energy prices. Well, they're not saying that anymore. Inflation for items other than food and energy remain near 2%. So, right, oil prices are up and we still don't have inflation. So anyway, so we're doing a comparative analysis. Now imagine if you were in college, you would have to write a 5-page paper doing a compare and contrast the two statements. Cite your sources. TradingNews.com, Baba. Okay. So how does it feel, guys? Your smart money. Does it feel good? Okay. So standard operating procedure is in here. Okay. The fact that we haven't breached the line in the sand should give you warts. Not the good, so we'll check it on the Fiverr. Okay? This is your last chance as far as I'm concerned. As far as a scalp is concerned. I don't know if you're scalping or not. That's all there is, Baba. And we need to breach. Okay? You guys want to do this again on Friday? And by the way, how come you haven't subscribed yet? What's wrong? Let's go. Kick down, come clean. Don't be a holdout machine.
Chair Powell starting his press conference.
Emilio, what's up, Copla? Hey, Emilio, did you blow out that account or you still got it? Still got my 20? Yeah, I'm doing non-farm payrolls on Friday. You're welcome to join me. It's at fxstreet.com. Cool.
All saying that data have been broadly in line with their expectations in the last 6 weeks.
Good job, Emilio. Oh, is it? It's early.
Powell did note that inflation has been somewhat weaker in the latest period.
Let me bring it up. Hang on. Let me mute my pornography in the background. Trader pornography. Trade the news. Hang on. By the way, I did apologize for calling that guy a poor white trailer trash. I apologized. All right, I need to do FOMC live. Get this going. No.
Inflation objective. For much of this long expansion, inflation ran a bit below our 2% objective, alongside considerable slack in resource utilization. But last year, with the unemployment rate at or below 4%, inflation moved up. From March through December, core inflation, which excludes volatile food and energy components, was at or very close to 2%. Overall inflation fluctuated from a few tenths above 2% to a few tenths below over this period, with the moves mostly due to changes in energy prices. As expected, overall inflation fell at the start of this year as earlier oil price declines worked through the system. Overall inflation for the 12 months ended in March was 1.5%. Core inflation unexpectedly fell as well, however, and as of March stood at 1.6% for the previous 12 months. We suspect that some transitory factors may be
Yes, it will, Johnny.
Thus, our baseline view remains that with a strong job market and continued growth, inflation will return to 2% over time and then be roughly symmetric around our longer-term objective. At the start of the year, a number of cross-currents presented risks to the outlook, including weak global growth, particularly in China and Europe, the possibility of a disruptive Brexit, and uncertainty around unresolved trade negotiations. While concerns remain in all of these areas, it appears that risks have moderated somewhat. Global financial conditions have eased, supported in many places around the world by an accommodative shift in monetary policy and in some cases fiscal policy. Recent data from China and Europe show some improvement, and the prospect of a disorderly Brexit has been pushed off for now. Further, there are reports of progress in the trade talks between the United States and China. The committee views these developments, along with the outlook for continued growth, a strong job market,
it's an M3 drop, guys, M3 drop,
as consistent with continued patience in assessing further adjustments in monetary policy. Over the past several months, we've made a number of consequential decisions about our balance sheet. In January, we decided to continue implementing monetary policy using our current policy regime, which involves providing an ample supply of reserves. In March, we decided to slow the pace of balance sheet runoff starting this month and to cease runoff entirely in September. These plans support our longer-run dual mandate objectives and also provide clarity about the path of our asset holdings. Today, we had a preliminary discussion about the longer-run maturity composition of the portfolio. Before the financial crisis, our portfolio was weighted toward shorter-term debt of the federal government. In the wake of the crisis, the Fed bought a large amount of longer-term securities with the aim of lowering longer-term interest rates and thus supporting the recovery. Because of these purchases, our portfolio is now weighted toward longer-term securities. As part of normalization, we will have to decide what maturity structure should be, what the maturity structure should be in the longer term. This choice raises many complex issues and has possible implications for the stance of policy. Today's preliminary discussion laid the groundwork for more complete analysis and discussion, and we plan to return to the maturity composition question toward the end of the year. There is no pressing need to resolve this matter, however, and any decisions we ultimately reach will be implemented with considerable advance notice and in a manner that allows for smooth adjustment. As we've often emphasized, adjustments to the balance sheet normalization process may well be needed as the process unfolds. Finally, we made a small technical adjustment in one of our tools for implementing monetary policy, the interest rate on excess reserves, or IOER rate. The change does not reflect any shift in the intended stance of monetary policy.
By the way, does anybody not know what that is? Nobody has asked me, so I don't know if you know. Everybody's good. You got the knowledge. All right, I'll continue.
We use the IOER rate to help keep the federal funds rate in our target range. As balance sheet normalization continues, we have expected that the effective federal funds rate would shift up over time relative to the IOER rate. Last year, we twice lowered the IOER rate by 5 basis points relative to the top of the target range after the federal funds rate moved.
Does anybody else need to know what that is? Okay. You're supposed to know, right? Where's my drawing tool? What color is this? Okay. 1 over R plus E. What is this? Are we going to go into a macro class? Oh my God, we're going to do a macro lecture today. Oh my God, I can feel it. Oh, IOER, huh? Wayne, what does it mean to drop the IOER? All right. You ready? All right. Let me change this to white, though. Okay. And then delete. It feels like a Khan Academy, doesn't it? There. All right. All right. In the United States of America, if you're running a bank, you collect deposits. Hang on, that's too fat. All right. In the United States of America, you collect deposits. Okay? And what do you do with the deposits? Hey, Cliff. What do you do with deposits? How does a bank make money? They loan it. Okay? Cool. So how does it actually work? Well, let's clean this up a little bit. Right? So you got to clean this up. All right, so you have someone deposits $1,000 in your bank. Okay? Is it a liability or an asset? This is called while you're doing that, this is called a balance sheet. Okay. I hope you're typing. You're a bank. Someone deposited $1,000. Yeah, it's a liability to the bank because you got $1,000. The reason it's a liability is that you owe it to somebody. Your depositor can show up tomorrow and say, "Give me my $1,000." But it's also an asset because you have $1,000. Okay. You typically don't make any money on that. What you want to do is you want to convert that into a loan. So what you'd like to do is drop, okay, so this is cash in vaults or whatever, and then you can call this deposits. Okay. But what you'd like to do is drop this to $100, or let's do it this way. Let's drop this to $500. You loan half of it out, let's say, right off the bat. You loan half out, so you have $500 in cash. Now what? But now you have $500 in loans, performing loans. So let's see if this balances. 500 in cash, 500 in loans equals $1,000 in deposits. Cool. It all balances. Okay. Someone might come in and say, give me $50, and you reduce cash and you reduce the liability. You have 450 here and 950 there, and it still adds up because 500 plus 450 is 950 plus 950 in liabilities, and it all balances. Okay. Now there's a rule in America. How much cash needs to go to the Federal Reserve Bank of America? Yeah, I know, Amelia. I don't know what's going on, but anyways. $10%? Cool. What if you deposited, so let's do, the formula, by the way, is 1 over R plus E. Sorry, R, let me do that again. Sorry, I didn't prepare for this, but anyways, R plus E. Okay. The Fed requires, so usually this goes up there by cash, but let's do this. Required reserves. reserve, okay, at the Fed. 10% of 1,000, so you have to have 100. So you should take this, drop this to 400, and 100 has to be parked at the Fed. But the bank can loan out 90%. Well, they've already loaned out 50%. There's still 40% left, right? But what if the bank at the end of the day says, we don't want cash in our vault, we want to send that to the Fed? Is that required? No. But remember, the Fed is a bank for banks. So now this bank says, we don't have any cash in our vault, our cash is zero, but we've put it in the Fed. So this bank has $100 required by the Fed to be put at the Fed, $500 in performing loans, and $400 in cash parked at the Fed. And the balance sheet still balances. 1,000 in assets, 1,000, right? So you go like this: 1,000 total assets equal 1,000, and then total liabilities. Total liabilities equal 1,000. What's the bank capital? Bank capital equals 0. Okay. So what we are talking about today, ladies and gentlemen, is this. What changed today was interest on excess reserves. And this is a whole new thing because interest used to be 0. But during the financial crisis, the Fed was very involved in trying to keep banks stable. It's one part of their mandate. So they said, look, we know now that you have money given to you by the government, we know that you can't find anyone worthy of investing or loaning your money out to. Plus, all they're going to do is buy a house that's dropping by 10% a month. So we know you have cash now, but you have nothing to do with it. So park it at the Fed, and we'll give you free money for it, interest on your excess reserves. Which is interesting because the government gave them the money for free, and then they put it in the Fed, which gave them money for free. But anyway, so this is what's changed. Now, this is important. This is important. How does 1 over R plus E impact the economy? How many people would like me to continue and explain the importance of this and what it'll do to the economy? Or how many people want me to just put up euro dollar? One to continue. Anybody else? Oops, got that backwards. But anyways, let me change color. All right, so 1 plus R plus E. What this means is the reserve requirement, the reserves that are required by the Federal Reserve. So we said if you're a bank, you're required by the Fed to deposit 10% of your reserves with the Fed. That's required. Okay? But then the Fed decided to, IORE on any money above 10%. These are excess reserves. E, required reserves plus excess reserves equal total reserves. Okay? You'll get this out of an economics class. Okay? So, when the Fed says, we will pay you money, free money on your excess reserves that you park at the Fed, what are they telling you? They're telling you, don't put it in the economy. Do you see that? Don't put it in the economy. You got free money, right? We gave you $500 billion when you got bailed out, and you parked it at the reserve, and you're earning money on top of your free money, which is free money. Why would you risk? Why would you risk if you can get free money for doing nothing on free money that you got for free? You see what I mean? You're making free money on your free money. Why would you put it to risk? So now what they're saying is less. And eventually, someday soon, they're going to say no more free money. So what do you think the bank's going to do? Loan it out. Why does a bank want to loan it out? To make money. But there's risk for that. No. Ye. I mean, a truck comes to your bank, you load it full of cash, and it drives to the Federal Reserve Bank and deposits it in a vault. I don't mean bonds. I mean cash. Okay? So by lowering the IOER, interest on excess reserves, they're saying take it out of the Fed and loan it out. Okay? Why does this matter? All right, so let's say you go to a bank and you borrow $1 million. Okay? So what do you do with it? You just leave it in the bank? You take out a loan, right? For 1M. What do you do with it? Stare at it? Do you put it in your bed and roll around? Do you Instagram it? What do you do with it? Yeah, we're going to quantify this, FX Pipper. We're going to quantify it. You buy something. Spend it. Yeah. All right, so you buy a house. Okay? So you convert your 1 million into a house. Now Johnny's got 1 million. What does he do with it? It goes to Johnny's bank. What happens next? $100,000 is parked at the Fed. The rest, I'll put Fed, and that equals required reserves. And then that bank now has 900K to either ER or loan. Well, if ER pays hardly anything or zero, then the bank wants to lend it out and collect 5%. Johnny goes out and buys something, and it goes to Jones Bank. Right? 90K gets parked as required reserves. 810 now get loaned out. That goes to Mike's bank, and so on and so forth, right? So if you follow this down and down from 1 million to 900 to 810, down, 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 down. Someone borrows the money, they spend it, it goes to someone else's bank account, and they spend it, goes to someone else's bank account, they spend it, so on and so forth. What is the end? Well, let's do some math. $1 million. Okay. We got 1 over R plus E. So let's define our variable. Required equals 0.1. By the way, how often does the reserve requirement ratio change? 1992. 1992, I think, was the last time. When was the last time you heard the Chinese central bank? You guys ever wonder about this? The People's Bank of China cut reserve requirements, and you're like, what does that mean? Now you know, that's what we're talking about. Okay? And let's say 10%, no, let's say 30% is parked at the Fed in the form of excess reserves to collect free money, IOER. Remember, they don't have to do anything. Put it in the bank, they're going to collect whatever it was. And it was 1.5% or something? 1.5% on $1 billion to do nothing? You see what I mean? Like, that's redonkulous, right? Millions and millions and millions of dollars for doing nothing. All right, cool. So let's add this up. 1 million, 1 over 0.4. Right? Anyone want to do the math? Just want to get this right. La la la. No, I don't want to. Clan. Okay. Clear, clear, clear. 1 divided by 0.4 equals 2.5. So times 1 million bucks. So this economy, okay, whatever economy this is, this economy turned $1 million into $2.5 million by loaning it out, parking some at the Fed, loaning the rest out, parking it at the Fed, loaning it out, parking it about, but up. The initial deposit's $1 million. Oh, but you're saying 2.5 million plus the 1 million? I'm looking at the delta, the change, okay? You see? Why do poor countries stay poor for so long? You ever wonder that? Does anyone live in a poor country that's been poor for like forever and you're wondering why it's still poor? They probably don't have a banking system. Your country probably doesn't have a banking system that turns 1 million into 2.5 million just by activity, economic activity. Okay? So what about a healthy economy? Okay? What about the United States of America before the great financial crisis of 2007? What was excess reserves in the United States in 2005, let's say? Oh, right on, guys. Yeah, this is off the top of my head. You guys are asking questions. We're just watching a Fed thing. So luckily I know this stuff. By the way, if you don't know this stuff, take the fundamentals course at fxbootcamp.com. If you can't just bust this out like me, then you lack knowledge. Don't get upset. Don't get pissed off at me. Just get smart. Now, so let's change this up. The world, how much excess reserves do you think the United States of America had in 2005? Zero. Whoa! What? So let's do it again. Okay. Let's do it again. Let's do the math. Let's go. Let's do it this way. Okay. One, too fat. Hang on. 1 over R plus E. Sorry, that was a plus. I'm having trouble with this. Equals 1 over R is 0.1 plus 0 equals, these are equal signs. Boy, you know, I'm doing this so poorly. Let's do it again. It's just not, there's a lag, I think, huh? 1 over R plus E is equal to 1 over 0.1 plus 0 is equal to 10. Times, that's the money multiplier. Oops. That is the money multiplier. Which will impact the velocity of money in the economy, times the original 1M. So this economy turns 1M into 10M. That, my friend, is the difference. So, let me ask you something now. The Fed lowered the IOER today. An hour ago, you never even heard of the IOER. Then you heard about the no interest rate cut. You're like, oh, look, nothing happened. And then you came here and you're like, Oh, wait, he said something did happen. What do you mean they cut the IOER? What the heck is an IOER? Now you know what the IOER is. You know they've lowered it. You know the strategy is because they're trying to get the money out of the Fed's vaults and into the economy by making loans more attractive to banks so that they take the risk. So now banks are going to withdraw money from the Fed, loan it out to people, stick it in the economy, and multiply every dollar by 10. Holy snap! The U.S. economy is leveraged 10 to 1. And you might be in a country that's not leveraged at all. Why? Because all the people in the country have money stuffed in coffee cans or stuffed in their mattress. It's not earning interest. It's not being reinvested into the economy. And most importantly, it's not being multiplied. A poor country has 0 leverage. A rich country has 10 to 1. Is it important that the Fed lowered the IOER by what was it? It was hardly anything, 0.005. Does that matter? Yupper. Yes, it does. You, my friend, are much closer to being smart money now than an hour ago. Would you do me a favor? Subscribe, like, and comment. Huh? We're doing this in the middle of a live presentation. Your coach just broke it down, and now you got knowledge.
Moved toward the top of the range. These actions helped keep the effective federal funds rate well within the target range. And today we made one more such change. The target range for the federal funds rate is our main indicator of the stance of policy, and it remains unchanged. Thank you very much. I'll be glad to take your questions.
Steve.
Thank you, Mr. Chair. Steve Leisman, CNBC. As the statement noted, core inflation are running below 2%. It's been falling for 3 straight months, and while you've been close, it's only been at 2% or above 1 month since 2012. Mr. Chair, I guess I wonder, is it time to address low inflation through policy? And can you give us some sense of your metric for when it would be time? At what level would it require a policy response from the committee?
So first, we are strongly committed to our 2% inflation objective and to achieving it on a sustained and symmetric basis. As I mentioned, we think our policy stance is appropriate at the moment, and we don't see a strong case for moving in either direction. I would point out that inflation actually ran, including core inflation, actually ran pretty close to 2% for much of 2018. As you point out, both headline and core, though, did come in on the soft side in the first quarter, and that was not expected as it relates to core. So we say in our statement of longer-run goals and monetary policy strategy that the committee would be concerned if inflation were running persistently above or below 2%. So persistent carries the sense of something that's not transient, something that will sustain over a period of time. And in this case, as we look at these readings in the first quarter for core, we do see good reasons to think that some or all of the unexpected decrease may wind up being transient. And I point to things like portfolio management, service prices, apparel prices, and other things. In addition, the trimmed mean measures of inflation did not go down as much. Indeed, Dallas trim mean is at 2.
By the way, you see how obvious this is for a swing trader that had this set up 2 days ago? Right? 2 days ago, this was set up for a swing trader, and they took it. Good for them.
But to go back to your question, if we did see a persistent inflation running persistently below, then that is something the committee would be concerned about and something that we would take into account in setting policy.
Sam.
Thanks very much. Sam
Sam Fleming from the Financial Times. Let me carry on the same theme. There's obviously been a lot of speculation in the markets about the prospects for a rate reduction this year. Do you think markets have effectively got ahead of themselves on this? And what sort of economic conditions would you need to see to give serious consideration of a rate cut? In discussion, for example, about the 1995 example, do you actually need to see a looming recession to cut rates, or could an insurance cut be appropriate? Thanks.
So, as I mentioned, we've just come through a 2-day meeting, and we've done a deep dive on economic and financial conditions in the United States and around the world, and thought about our policy. And we do think our policy stance is appropriate right now. We don't see a strong case for moving in either direction. So we do, of course, though, as a routine matter, as you will know, we look not only at our baseline, but we also look at alternative simulations, both better and worse, and we ask ourselves what the appropriate policy response would be. But that's all we do, and I would just say that we're comfortable. The committee is comfortable with our current policy stance.
Howard.
Hi, Howard Stein with Reuters. Shifting gears a little bit, I wondered if you could flesh out, I know you're describing it as a small technical adjustment, but on the IOER federal funds spread, give us a sense of why it matters whether or not this reaches the upper limit a little bit. Is there any feed through to broader credit conditions and financial conditions that you worry about, or is it simply a matter of the Fed showing that it can control what it says it's controlling? And I do have a follow-up.
A small temporary deviation outside of the range would really wouldn't be important, as your question suggests. But we do think it's important that we be able to control the federal funds rate and generally keep it within the range. That's just good monetary policy, good monetary control. So, we think it's important, and we have the tools to do that. So we've used them again today. And again, this is just a technical fix. It really has no implications for policy.
But as a follow-up on this, it is demonstrating that you control the market you want to control. And I guess the question is, at what point would these steady declines in the IOER and the steady widening of this spread, if it continues, essentially become the policy choice?
Right on, Bubba. Make sure you subscribe.
Generally speaking, the federal funds rate, we control only directly the federal funds rate in terms of the market rate. And the transmission of the federal funds rate into other short-term rates, money market rates, has been very good over a long period of time. And that's important because it's really broader financial conditions that matter, not so much precisely the federal funds rate. So I think the Fed controlling the federal funds rate is actually important from that standpoint. And I don't see us not controlling it. So I think we'll continue to control it, and then we'll continue to transmit it well into broader financial conditions.
Michael McKee with Bloomberg. I'm curious about the financial conditions that you see out there. The minutes in the March meeting tell us a few officials worried about financial stability risks. Was there a broader discussion at this meeting?
By the way, do you think there's politics involved? CNBC first, Financial Times second, Bloomberg third. Anybody think that's a coincidence?
Consensus on whether such risks are growing as the markets hit new highs and we do see some instability in short end trading. Is it possible that rates are too low at this point?
So we actually have a financial stability briefing and opportunity for comment every other meeting. So we had our quarterly briefing yesterday, as a matter of fact, and had that discussion as well. And I think there haven't been a lot of changes since the last meeting, but I'll just go through the way we think about it. First, we've developed and published our framework for assessing financial stability vulnerabilities, put it out for comment, and welcome any feedback that we get from the public. And that enables us to focus our assessments, regularly on the same thing so that we can be held accountable and be transparent. So there are four aspects of it that I'll go through quickly, but I'd say that the headline really is that while there's some concerns around non-financial corporate debt, really the finding is that overall vulnerabilities in the financial stability vulnerabilities are moderate on balance. And in addition, I would say that the financial system is quite resilient to shocks of various kinds with high capital and liquidity. But the four things we look at are first asset prices. And as for asset prices, some asset prices are somewhat elevated, but I would say not extremely so. Leverage in the financial sector, I mentioned. Households are actually in good shape from a leverage standpoint. Default rates are low. Borrowing is relatively low. Non-financial corporates is an area that we've spotlighted and focused on for attention. And there are concerns about that, not so much from a financial stability standpoint, but from the standpoint that having a highly leveraged corporate sector could be an amplifier for a downturn. And then the last two things are really about the leverage in the financial system and funding risk, and those are both very, very low by historic standards in the United States. So on balance, in my view, vulnerabilities are moderate.
If I could follow up on that, I'm just curious as to whether the level of asset prices is a reason why you might not be interested in cutting rates.
Yeah, so we do say that risks to the financial system, or we say in our longer run statement of goals and monetary policy strategy, that risks to the financial system that could prevent us from achieving our goals are something that we do take into consideration. I would say that, though, that really the tools for addressing those concerns are...
But see, it's not just cheap money. We already had cheap money. They haven't changed the price of money. They've simply, during the financial crisis, they were enticing. Remember, they can control. What he was saying here is we can control the Fed funds rate. Can they control whether a bank deposits, makes a loan or not makes a loan? No. That's a bank management issue. So they can entice a bank manager to say, hey, if you park money at the Fed, we will pay you. We will give you free money. And 1.5% on $1 billion or $1 trillion is a lot of money for doing nothing. Okay? So now what they're doing is influencing bank managers to take more risk, put more money in the market, make more loans. It's making the market more liquid. It's putting more cash in the market. More cash, more velocity of cash, creates more investment and more spending, which eventually leads to what? What does an increase in velocity of money, which means there's more money, but each dollar is being spent over and over and over again. Right? If I buy a house, it goes into someone's bank account, they go out and spend it, and that goes into someone's bank account, and they spend it, and goes that. My dollar gets spent 10 times. The velocity is 10 times, right? So what does this all create? More money in the market, more investment in the market, more spending in the market, the velocity and turnover of each dollar increases, creates inflation. Yes, and that's what they're trying to do. Pachow. Pachow. There you are. Well, we already have a growing economy. We're trying to create inflation. They're not creating economic growth. They're creating inflation. They're adding more money to the market. No, it's not just velocity. Velocity means no monetary policy. Let's say the amount of money is fixed. Let's say there's $1 trillion and everyone has to share it. There's 330 million people in America, and we all have to spend we only have $1 trillion, right? So it's not just the velocity, because the velocity by definition is how much $1, the same dollar bill, changes hands. So if all the dollars are in the bank, nothing happens. There's no velocity. But if the $1 gets spent here, over and over and over, it measures the demand for money. So I'm not going to go into demand curves and supply curves. I don't think. No, I don't want to do it this time. I've run out of time. I don't want to start. I totally can and I totally have, right? So it's not necessarily the velocity. It's the increase in supply of money. They're increasing the float, if you will. They're increasing the amount of dollar bills actually in the economy. Okay? More money means each one is easier to get, which increases spending, which increases demand, which increases spending, which increases demand, which increases spending. Everyone's filthy, stinking rich. The economy does great, but another reason it creates inflation is when Americans are filthy, stinking rich, we start buying stuff from China and from Germany and from Japan and so on and so forth. That means the money leaves the country, weakens the dollar, because now the supply of money, not just in our economy now the supply of US dollars in the interbanking system goes up. And when the supply goes up, the value goes down, the dollar weakens, Americans are filthy, stinking rich. And things like oil prices start to go up, gold prices start to go up, real estate prices start to go up, employee wages start to go up, and all of a sudden, we got ourselves inflation. So I hope you appreciate the impromptu lecture. I'm sorry. I didn't know you wanted to talk about this, so I didn't have anything prepared. But it was you and me and a couple other currency traders just talking shop, and I hope you thought that was cool. So make sure you subscribe, make sure you like, make sure you comment, make sure you do the little thumbs up thing. Visit my webinar tomorrow, 7:30 in the morning, on the Forex.Today YouTube channel. Visit tradersway.com. Open up a trade account today. If you like my chart templates with all the pivot points and all the profiles and all the indicators, in the description below, you can download all of that for free. Thank you, Traders Way. Thank you, Traders Way. And then on Friday, I'm doing a 3-hour webinar at FX Street. So I'm around, man. I'm trying my best to help you. I hope you know that, and I hope you appreciate that you have someone looking out for you. So, like I say every day, but I mean it every day, peace on earth. May the pips be with you. May your profits be above average. I'll see you on the next gig, huh? Remember, subscribe, watch all the videos, leave comments, leave likes. Come on, takes you only a few seconds. Kick down, come clean, don't be a holdout machine.